Mortgage rates in 2026, when will they finally drop? A data-driven breakdown of where rates stand today, why they're stuck, what the Fed is actually doing, and 3 honest scenarios for where rates go by year-end, using live data from Freddie Mac, Fannie Mae, MBA, NAR, Wells Fargo, and the Fed's own April 2026 FOMC statement. 6.3%. That's where the 30-year fixed mortgage rate sits right now, as of this week. For millions of Americans sitting on the sidelines of the housing market, watching, waiting, wondering when it's finally going to get cheaper to borrow, that number feels like a wall. If you bought or refinanced during the pandemic, you might be sitting in a 2.75% or 3% mortgage right now, feeling pretty grateful. But if you're trying to buy your first home in 2026, that 6.3 feels brutal. And the question you keep asking, the question that brings millions of people to Google every single month, is simple. When will mortgage rates finally come down? Today on Housing Pulse, we're going to answer that question honestly. We'll break down exactly where rates stand, why they've been so stubborn, what the Federal Reserve just decided this week, and what 3 different scenarios look like for rates by the end of 2026. Stay with me, because what the data actually shows might surprise you, and it will definitely help you make a smarter decision about your next move. Where we actually stand, the rate timeline. To understand where rates are going, you have to understand how we got here. And the story of mortgage rates over the past 6 years is genuinely one of the most dramatic in modern financial history. In January 2021, the 30-year fixed rate hit an all-time historic low of 2.65%. That was the pandemic era. The Fed had flooded the economy with cheap money to keep things from collapsing. What followed was an unprecedented home buying frenzy. Then inflation hit. And hit hard. The Fed responded with one of the most aggressive rate hiking campaigns in its history, and by October 2023, 30-year mortgage rates had surged to 7.79%, a 23-year high. That's when the housing market essentially froze. The Fed then made 3 consecutive cuts in September, October, and December of 2025, totaling 75 basis points. Rates responded, falling from around 6.8% to roughly 6.25% by year-end. In February of this year, rates briefly dipped below 6%, hitting 6.09%, the lowest in over 3 years. Then, geopolitical tensions, specifically the conflict in the Middle East and rising oil prices, pushed them back up. Today we sit at 6.30%. That's actually 46 basis points lower than this time last year. Meaningful progress. But it's still a far cry from the rates that made the pandemic housing boom possible, and it's still high enough to keep millions of buyers on the sidelines. That payment table tells the whole story of why the housing market is frozen. We're talking about $710 more per month, $8,500 more per year, compared to what buyers were paying at the 2021 low. That's not a rounding error. That's a car payment on top of your mortgage every single month for the life of the loan. Why rates are still stuck, the 4 forces holding them up. Here's where a lot of people get confused. They hear that the Fed cut rates 3 times in 2025, and they think, so why is my mortgage rate still above 6%? This is one of the most common misunderstandings in personal finance, and it's worth clearing up properly. The Federal Reserve does not set mortgage rates. What the Fed sets is the federal funds rate, the rate banks charge each other for overnight lending. Mortgage rates are primarily driven by the 10-year Treasury yield and the broader bond market. The connection exists, but it's indirect. And right now, 4 specific forces are keeping the 10-year yield, and therefore mortgage rates, elevated. Force 1. Inflation is still above target. The Fed's goal is 2% inflation. Right now, we're sitting at approximately 2.8%, better than the 9.1% peak in June 2022, but still not where the Fed needs it to be before it feels comfortable cutting aggressively. As long as inflation runs hot, bond investors demand higher yields as compensation, and mortgage rates follow. Force 2. The Middle East conflict. The ongoing conflict involving Iran has constricted global oil supply and pushed energy prices higher. Energy costs feed directly into inflation. The MBA's chief economist noted that mortgage rates moved over 30 basis points higher in just 3 weeks as markets priced in that inflationary risk. Geopolitics and mortgage rates are more connected than most buyers realize. Force 3. The mortgage spread is still wide. Even if the 10-year Treasury yield were to fall, mortgage rates wouldn't necessarily fall by the same amount. There's a spread, a premium, that lenders charge above Treasury yields to account for prepayment risk, default risk, and their own operating costs. Normally, that spread is around 1.5 to 1.7 percentage points. Right now, it's significantly wider, meaning even if Treasuries improve, the benefit is partially absorbed by lenders rather than passed through to borrowers. Force 4. Leadership uncertainty at the Fed itself. Jerome Powell's term as Fed chair ends May 15th of this year. President Trump has nominated Kevin Warsh to replace him, but that confirmation hasn't happened yet. Bond markets hate uncertainty. When investors don't know who's going to be setting monetary policy, they price in a risk premium, and that premium shows up in mortgage rates. What the Fed just did, breaking down this week's decision, here's something that makes this video particularly timely. The Federal Reserve just wrapped up its April 28th and 29th FOMC meeting, literally this week, and the decision they made matters directly to anyone watching the mortgage market. The Fed voted to hold the federal funds rate steady at its current range of 3.5% to 3.75%. This is the third consecutive hold of 2026 after the 3 cuts at the end of 2025. What's notable about this vote is actually the dissents, and they came from both sides. One member, Stephen Moran, wanted to cut rates immediately, arguing the economy needs more support. But 3 other members, Hammock, Kashgari, and Logan, went the opposite direction. They didn't just want to hold, they wanted to remove any language in the statement that even hinted at future rate cuts. They're essentially saying, don't promise what you can't deliver, and or don't signal cuts when inflation is still a problem. That internal disagreement tells you something important about where the Fed stands right now. This is not a committee that's itching to cut rates. They are genuinely divided on the direction of risk, and as one FOMC participant put it in the March meeting. Minutes, all participants agreed that monetary policy was not on a preset course and would be determined on a meeting-by-meeting basis. There are still 5 Fed meetings left in 2026. The next one is June 17th and 18th. The question isn't whether the Fed will cut again. Most forecasters still expect 1 to 2 cuts before year-end. The question is when and by how much. And the honest answer is, it depends entirely on inflation data and the job market between now and then. What the experts actually predict. Year-end rate forecasts. Let's look at what the major institutions are actually projecting for mortgage rates by the end of 2026, because the spread here is pretty telling. So the most optimistic camp, Fannie Mae, NAR, Morgan Stanley, sees rates potentially getting to the high 5s by year-end. That would require the Fed to cut at least twice and inflation to continue cooling meaningfully. The more cautious camp, Wells Fargo, MBA, thinks rates stay stubbornly in the low 6s. Wells Fargo's economic team specifically projected rates averaging 6.14% for the full year 2026 and 6.19% in 2027. They're essentially saying, don't expect significant relief. This is the new normal. The consensus range, 5.80% to 6.30% by December 2026. From where we sit today at 6.30%, that means the optimistic scenario gives you about half a percentage point of improvement. The pessimistic scenario gives you essentially nothing. And here's the thing about that half point that most people underestimate. On a $327,000 mortgage, the median loan after 20% down on today's median home price, going from 6.30% to 5.80%, saves you about $100 per month. That's $1,200 per year. Not nothing. But it's not the dramatic relief people are waiting for. The 5% rates of 2022 feel like a completely different universe, and according to every major forecaster, they're not coming back in 2026. 3 honest scenarios for where rates go by December. Rather than pretending anyone can predict the future, let me walk you through 3 concrete scenarios for where rates end up by December, and what needs to happen for each one to play out. Bull case. Needs to fall to 2.2% to 2.5% consistently over the next 3 to 4 months. The new Fed chair stabilizes market confidence. The Middle East situation de-escalates enough to bring oil prices down, and the Fed cuts twice, in September and December. Base case. Rates drift to 6.00% to 6.15% by year-end. One Fed cut in Q4. Inflation stays in the 2.5% to 2.8% range. No major new economic shocks. Mortgage Treasury spread begins to normalize. This is what Wells Fargo and the MBA are essentially projecting. Bear case. Rates stay at 6.25% to 6.50% or even tick higher. Inflation re-accelerates due to oil price spikes. Fed holds all year with 0 cuts. New Fed leadership creates policy uncertainty. Bond markets sell off on fiscal concerns. MBA's MBA, chief economist, flagged this risk specifically. 30-plus basis point jumps are possible on a bad inflation print. As of right now, with the Fed holding this week and the geopolitical situation still unstable, the base case is the most likely outcome. We're probably looking at 1 cut, maybe 2, and rates settling somewhere in the low 6s by December. Not a dramatic change from where we are today. The bull case is possible. It just requires several things to go right simultaneously. The bear case is the scenario nobody wants, but that the data can't rule out. And there's one number I want you to hold on to. To reach 5%, we would need the Fed funds rate to fall to 2.5% to 3%, from its current 3.5% to 3.75%. Even with 2 cuts in 2026, we'd be at 3.0% to 3.25%. We'd still be well above the level. Needed to get 30-year mortgages into the 5s sustainably. According to most forecasters, the earliest realistic window for 5% rates is late 2027 or 2028. Not this year. So what should you do? Practical guidance for every situation. Okay. So you've heard the data, you've heard the forecasts, and you're probably still sitting there asking, but what do I actually do? So let me be direct. If you're a first-time buyer who's been waiting for rates to drop, the data suggests you could be waiting a long time for significant relief. And there's a real cost to waiting. Every month you wait is a month you're not building equity, not locking in today's price, and potentially facing a home price increase if and when rates do drop and demand surges. As one industry expert put it recently, if you find the right home and can afford the monthly payment, take the opportunity in front of you. You can always refinance when rates fall. You can't buy at today's price once demand returns. If you're an existing homeowner sitting in a rate below 4%, you're in an enviable position. Don't give it up unless you have a compelling reason, a job change, a growing family, a life event. The rate lock-in effect is very real, and the premium you'd pay to move right now is significant. If you're considering a refinance, run the numbers carefully. Refinancing only makes sense if your current rate is significantly higher than today's offerings and you plan to stay in the home long enough to recoup closing costs through monthly savings. A rough rule of thumb, you need to stay in the home at least 2 to 3 years after refinancing to break even on costs. If you're a real estate investor, watch the next 2 or 3 inflation prints closely. The September Fed meeting, the one most likely to deliver the next cut, will be heavily influenced by June, July, and August CPI data. If those numbers come in below 2.5%, the rate environment changes. If they don't, nothing changes. The bottom line on mortgage rates in 2026 is this: modest improvement is likely. Dramatic relief is unlikely, and the 3% era is not coming back. The new normal for mortgage rates appears to be somewhere in the 5.5% to 6.5% range. And the sooner buyers, sellers, and investors internalize that, the better their decisions will be. We're going to keep tracking every Fed meeting, every inflation print, and every mortgage rate move right here on Housing Pulse, so you always know what's actually happening before it makes the news. If this breakdown gave you clarity, hit subscribe. We post new analysis every Monday and Friday. And drop your question in the comments. Are you buying, waiting, or thinking about refinancing? Tell me your situation. I'll respond, and we may even feature your question in a future video. Next up, we're taking a deep dive into the 5 U.S. cities where home prices are dropping the fastest right now and where the real hidden opportunities are. You won't want to miss it. I'll see you in the next one.